Welcome everyone to Hunting for Head Fakes. In this webinar, I'm going to go over some really cool stuff that probably you've never heard of before. And I'm generally doing it straight from the hip. So if you have any questions, or if I skip around too much, I'm going to try to stay focused and not pontificate that much in this lesson. But if you have any questions, feel free to email me anytime that you want, and I'll be happy to answer your question via email. If I can't answer it via email, in other words, it's just too much typing, I'll gladly give you my phone number and we can chat about it. But tonight we're going to talk about a couple of things that we can use against the creature. And the creature is the institutions. And I'm going to give you some clues to the way they think, because I was at one time a creature myself. And I understand what they're doing in the marketplace, and sometimes I can just see it. And I get some of my best trades by actually knowing what they're doing and actually going with them. So what we're going to talk about tonight is an interesting concept called the market paradox. And not many people mention the market paradox. And the market paradox states this: that markets are driven higher to create better selling opportunities for the strong hands, forcing the weak hands out. And markets are driven lower, creating better buying opportunities for the strong hands and shaking the weak hands out. So generally what I'm saying here is that if people are trying to be trend followers and they've never really had a lot of experience in trend following or swing trading or virtually any other type of popular trading system, they use a lot of lagging indicators which alert you too late to enter trades at profitable points. Because if you guys are using moving averages or any type of stochastic or MACD, okay, by the time the thing really turns down is really probably the time that you should go the other way and buy. You actually go long. See, the reality is that nothing ever goes in a straight line, that's for sure. Sometimes it does. Sometimes it just rockets. But generally, there is a reprieve in prices. And just when you think that the price is going up because the move has happened and wow, it looks like it's just bid to the sky, bang, that's when it crashes down. And that's generally when you sell. And most likely when you sell, you're probably selling very close to the bottom if it's truly an uptrend market. If it's not an uptrend market, okay, you sold well and got out, and you basically were standing in front of a freight train. The PriceFlip, or the head fake, is an invaluable resource that can help you optimize your results if you want to know when to add to a position, if you don't want to know when to exit a trade. Okay, make sure that you're exiting a trade profitably when the price could be flipping on you. And it basically help you protect your capital at critical reversal points. Now, let's get back to the market paradox. And exactly what does this mean? Well, like I said, markets are driven higher in order to create better selling opportunities for the strong hands, and they're also driven lower in order to create better buying opportunities for the strong hands. The strong hands would be the creature, or the institutions. So some of my friends still work there. I should be rather nice, but let's just take this example. And I'm using sterling Swiss because it's not a cross that's really actively traded often, but it is traded, and some people may trade it. I very rarely trade sterling Swiss. I would rather trade sterling yen or euro yen, or I'd rather trade sterling euro sterling. That's sterling Swiss. I don't know. It just doesn't really I've never really traded it, so that's just the way it goes. Let's take this for an example though, because it's a really good platform to use to talk about the market paradox so that you understand it. As price is moving, and if I'm just looking at this marketplace, I'm using a 4-hour chart here. Again, I'm using it for the platform because all the ideas and the philosophies are the same on a 4-hour chart that they are on a daily chart. Now, generally, you'd want to be looking at a daily chart to try to ascertain the overall trend in the marketplace. But a 4-hour chart is half a day, so it's just going to be twice the amount of data, so we can use it. Generally, as price moves lower, or by definition, as price moves lower, it's moving to ultimately its lowest price point before it has a reaction and a reprieve in price. As price moves higher, it's ultimately moving to its highest point before it has a reprieve and it heads lower. Now, whether or not the trend changes is the key. The trend is your friend unless it's about to end. Okay. Oh, this is a good one too. I want to mark this for you guys because I want to mention key reversals, and key reversals are pretty important. Okay. So what generally happens is this marketplace, if I just collapse the data a little bit, has been moving obviously in a downtrend. Okay. There are a couple of times now. Many times it happens as the trend is moving down, but let's just use this specific example that's right in front of us. Let me get rid of this thing. Market came down ultimately to this price low right here, okay? And then this is probably the deepest low that we have for quite a while. Aside from that, I don't want to talk about how you can try to look for bottoms. We don't ever really look for bottoms or look for tops, but if we do the right thing over and over again, we'll naturally find them. So I don't actively search for bottoms and tops. I'm not crazy enough to think that I can find an ultimate bottom or an ultimate top, but I will probe a marketplace at what I think could be kind of bottomish, and I will probe a marketplace at what I think could be topish, and I'm going to show you how I do that, exactly how I do it, in the head fake course and through the webinars that I'm going to be holding. But this little blip in prices, or this blur right here, this little burp right here, okay, was the market paradox at work. It also happened here. 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 It also happened from here to here, and ultimately from here to here. Okay? What the institutions did was, on each instant, I'm talking about this low being made, okay, they drove prices higher in order to squeeze out the weak hands. Okay, they had to. Okay, they were getting long all the way down. Because remember, a market maker generally, all he does or she does is they're the opposite side of the market. So as the marketplace is selling, they're buying. They need to get a reprieve. They need to escape their positions. They need to, what they call, lighten their book. There is no trader at an institution that's going to be holding longs all the way down. They just don't do it. They're going to get out. And they're going to get out, and how they're going to do that is they're going to look for corporate buyers, and they're going to drive the price up so that they can start selling up here. Now look at this head fake. It's a perfect head fake. Okay, that's another thing I have to go over. What exactly is a head fake? So let's take that opportunity, just in case some of you that don't know what a head fake is. A head fake is generally, what you're doing is you're comparing, if I'm looking for a head fake to sell, an upside head fake, okay, if I'm looking for an upside, and it happens on every one of these. Maybe I should trade Sterling Swiss. Looks like it's pretty hot to trade it, but aside from that, sorry. If we're looking for a head fake to sell, we are comparing two up closes. Let's just open this up really wide. Gotta make sure that I zoom in on this stuff for you. And let's look at these two right here. A head fake occurs right at this price. Okay. I'm comparing, since this close, this close to this close. I'm comparing this close to high to this close to high. These two bars, because they're two up closes, I'm looking for this bar. If close to high, the distance between the close to high on this bar is greater than the distance between the close to high on this bar, we have a head fake. In other words, there are a lot of trapped traders up here. Now what that means is as the market starts going down, they're going to puke. They're going to get out. Now here's a downside head fake. Okay, so here's an upside head fake. We're comparing two up closes, two bars that are up closes. I don't know what a candle would look like. I don't use candles. I only use bar charts because I don't need to color this in like a firecracker. It doesn't make a difference to me. I mean, a bar chart is, for me, is everything I need. Open, high, low, close. That's it. I don't need fancy stuff. I get confused easily. So once again, we're comparing two up closes. Okay, and then what I'm doing is saying, okay, the current bar, let's say that this never happened, this market never happened. We don't know that. This bar just closed. This is the most recent bar we have. It just closed. So what I'm doing is I'm saying, okay, is the distance between this close and this high greater than the previous bar between this close and this high? The answer is yes. This is a potential top. So you would take a trade, if you were just doing a straight head fake trade, you would sell the open, you'd place a stop loss 30 pips higher than this bar. Okay, and as you can see, if you were fortunate enough to take this trade, put your stop 30 pips higher, didn't get scared out on the next market paradox run up, you would have caught a pretty darn good move. Okay, you would have probably caught from 145 to 142. 3 big figures. Not bad. Okay, let's look at a head fake upside, or in other words, we're comparing two down closes. Okay, and our software gives us the ability to adjust what we want as far as distance is concerned between the close and the low, close and the low, or close and the high, close and the high. Okay, so we actually can adjust this so that we only look at head fakes that have X amount of pips difference. Okay, but if we look at this close to this low, let's say this is the current bar right here, this close to this low, the distance between this close and this low is greater than the distance between this close and this low. So this should be a bottom. It should hold for a little while. If we were in an uptrend, this would probably be very close to near the bottom or the bottom itself, and the market just rockets up. But here's the market paradox at work. Market's driven higher up to this point to create better selling opportunities for the strong hands. Then they sell it off again. Or the market forces come back in, start selling it off, selling it off, selling it off. Bang, market paradox again. The institutions, they got to get rid of stuff. So they start pushing, right? They bring the marketplace up. They're selling all up in here. They're trying to get square or lighten their book. Bang, another head fake occurs. Okay? This close, if this is the current bar, this close to high is greater than this close to high, and then the market, bang, starts selling off. So the market paradox is used basically when you ascertain the trend, and the trend's been moving down, where you're looking for that spike up. You're waiting for the market paradox to start working in your favor, whereas the institution or the creature starts bringing the price back up, not for a reversal in trend. Most novices would be looking at this going, oh my goodness, it's going to break the resistance line, it's going to go to the moon again, everybody's short, I'm going to make a lot of money. And they buy this top, only to have it crash back down, then they sell the bottom. And then what happens? They're stuck. Psychologically, traders can get stuck because they get angry. And they can't believe that they just bought this and sold this. So what happens? They get patient. They don't buy again. No. They buy this again. And then what happens? The market reverses on them again and crashes down lower. And now they start to think, oh my God, they're after me. every time I buy, it goes lower. Every time I sell, it goes right back up. They're after me. Who the proverbial they are, I don't know. But it's not, nobody's after you. It's just that you're not understanding the inner workings of the marketplace. You're not understanding the market paradox. So, in order to use the market paradox correctly, ascertain what the trend is. Look for the reaction back up, the natural reaction that I call it really a natural rally to occur. Okay, and then instead of buying it, look to sell it and look for a head fake to sell it. In trading, often what feels good is the wrong thing to do. It would feel really good to buy this. It would feel really good. It would feel real. Oh wow, it's going up. It feels great. And it would feel really good to sell this. Oh God, I'm so glad I got out of that bad trade. So, in trading, often what feels good is the wrong thing to do. The trade that feels like you're catching daggers is probably the right trade. If you think about the psychology behind this, if you saw this movement starting to occur up, now you're looking at pivot points. You know, what's an important pivot point? Well, you got a minor pivot point here, you got a major one here, you got another major, you got another major. Getting short near a major pivot point is pretty safe thing to do. I mean, everybody's, in this instance, okay, everybody's been buying for these amount of this day and a half. Everybody's been going long, okay? And everybody's starting to change their opinion. All the short-term guys are starting to change their opinion. Okay, if you're just sitting on the sidelines, keeping your gunpowder dry, marking a pivot, marking pivots, going, you know what, I'm waiting for a head fake to occur at this minor pivot. Now, I would really love it to occur at this upper pivot. You know, it would be great if it could occur there. But if I see something in this area, I'm going to go short, put my stop loss, you know, above this pivot, and then I got to, you know, calculate risk reward. You know, what am I risking? You know, what's the top here? 60 against the figure, so it's 40 pips. That's a normal head fake trade, by the way. You're using about 35 pips, 40 pips. And you say, I'm going to put my stop up there, and then I want, you know, 2 to 1. So if I'm risking 40, you know, I want 80 back. And then you just realize that you're going to get it if you sold this, you know, so 40, you get actually more right here, 43.17. You got plenty as far as risk reward was concerned. But the safest trade was actually selling up here, because you're selling into a marketplace that's been being bought up. Now, when you're totally wrong, this will blow right through here. You'll get stopped out. It'll just keep going. Then you got to start to think, holy smokes, this marketplace has changed. Something's going on here. You know, I got to start looking for head fakes the other way. So now I've basically given you the market paradox. Now let's continue on. Let's get rid of this line. Let's get rid of this line. Let's get rid of the downtrend. Oh, I shouldn't have deleted the arrow. That's alright, I got another one up. Where was it? I lost that little guy. Because I wrote a note to myself to remember to talk to you about key reversals. Okay. That's not a good one. This is for an upside, so we don't have to worry about that. Okay, so we talked about the market paradox. We're going to talk about it again. Let's look at this marketplace right here. We have a bottom, okay? Then we got a higher bottom. Then we got a higher bottom, okay? I'm just marking this, okay? This market had turned at this point. It created a head fake right here. Okay, if I took the difference between this close and low compared to the difference between this close and low, this was a head fake. If if you took this head fake, and there'd be many reasons why you'd want to take it, but and that's beyond the scope of this little webinar. However, if you took this head fake, okay, and you had a 30-point stop, you notice that you would have bought, say, and let's be fair, let's say you bought 141 the figure. Let's say you bought this, okay, because you were patient, or you could have bought this. Sorry, you could have bought 140.89. The low was 53, very close to your stop. If you bought the original, the head fake itself right here, close was 86. Okay, so really your stop would have been like 45, and the low was 46. 48. Unbelievable. 1 pip from a stop. All depending on your broker, you might not have made it, but the head fake was a good indicator. You would have had to manage that trade. That would have been quite difficult if you had a lousy broker. But look at this marketplace moved straight up. Oh, and actually, I'm sorry, this is sterling Swiss, so the stop would be wider than 35, 40 points, probably like about 50 pips, because this is a crazy cross. Sometimes some platforms quote it 15 points wide, which is ridiculous. But anyway, if you would have bought that, you could have had a nice ride up to 146. So that's 6 big figures in the amount of, I don't know what, from August 1st to the 15th. That's pretty damn good. I mean, 6 big figures. Okay, but let's talk about the market paradox again. Markets, out of nowhere, it starts moving higher. Okay, now here's a clue that it's going higher. Okay, once you start breaking these old pivot highs, where this should have been resistance, natural resistance for the market to push back down again, and it's not, and it's creating new highs. For me, anytime I see a pivot point break, it's the first crack in the glass telling me that I'm probably going higher. Now you can sit here and go, Tom, I mean, it went up here and then it fell all the way down here. Well, this is the market paradox again at work. Markets being driven up higher, creating better selling opportunities, and then the institutions take it right back down. Now, they started the same pattern again here. So I even think the institutions were a little confused here, because what they did was, here's a head fake saying back up, and what does it do? It rallies here, and then starts coming off again, coming off again, coming off again. This is basically right around where Gann would say that you should start looking at 50% retrace or so. You start be looking for, reversal here. Now, the marketplace went to 146 and it fell down to 142. So it basically fell about 4 big figures. So a little bit more than 50%, because 50% is right around 143, right? So the marketplace reversed here. Okay, so now it starts moving up. Now it's getting crazy. Now here we go. Okay. I put here explicitly, I wanted to mention key reversal, and it's really important. Key reversal is a really cool indicator that you can basically figure out what and when the creature is at work. Okay? And it is the indicator of a market top coming soon. It doesn't mean it's happening at that instant. It means that you must be on alert that if you're long, if you got long at 142 and it's 147 and you see this pattern happen, you need to get ready to get the heck out. Okay? And what is this pattern? Generally what it is now, I like it to be a little bit deeper than what this is. Right here we have a top that's formed. Okay, we got a head fake here, marketplace is topping out, it does this drop, but the first precursor to this drop before this rally is that we had a market that actually opened, went lower, and then zoomed up and closed extremely strong. This is a key reversal. This is the market flashing to you that this is a potential top coming. When? You don't really know when, but it's going to be in this area. Okay, so right now, if I saw this, okay, if I was long, I'd say, I got to get the heck out of this thing. Okay, I don't care if I would have sold even 146s. It didn't matter to me. I'm out. I'm not going to start playing with this key reversal signal. Obviously, I'd want to sell it as quick as I could. If I saw that happen on this 4 hour, I'd get out as fast as I could. Maybe 147.07 or something like that. Who knows? Who cares? But this is the first indicator that the market is topping out. Now, I like this. For me, if you have 30 pips, it's probably going to do it a few times before it really falls on you. If this was 100 pips, like in other words, we open up and this market falls 100 pips down and then reverses back up strong, that is a damn good indication that the institutions are getting the hell out and a top is coming soon. They're not done lightening their load yet, but they're looking to get out for whatever reason. We're not going to talk about inside information. It never works anyway, but mostly what will occur is they'll be getting a load of corporate customers coming in and dumping, getting out, because corporate customers have interest in this. Okay, they're British companies and Swiss companies, right? So they're naturally in sterling Swiss as a cross. Okay, so if they have receivables that they have to get rid of, they're basically coming in naturally and doing their business. Then that will create, the spike down, and then, the bankers don't want anybody else to know that it's going to collapse. So what they do is they start calling all the customers, maybe not so much involved in sterling Swiss, and getting them to help buy the marketplace back up. That's the key. Now watch this. I'm going to just mark this. Okay, right at this key reversal. Okay, I'm going to put my line here. And we're just going to go forward in time. We have a head fake that occurs right at our red line here. Okay, that's pretty good. All right. If I was to take this trade right here, we're selling short at 47.45. The high is, say, 90. 148.30 would be the stop. I can even put the line up there. So copy it. 148.30 would be the stop on that trade. Market comes up again, creates another head fake right here. Okay, we have it stopped out. That's another indication. All right, now I'm looking for another key reversal. In other words, down and then back up. I don't see any. Head fake, small head fake down, saying maybe one more push up before we go down. Push back up. There's the push up, probably from this little head fake. Head fake downside. Okay, basically saying, okay, we should hold. Now watch this. This is where people say, well, each one you should buy and sell each one. No. If you saw the key reversal and you got short, at this head fake, okay, and you have your stop up here, you are hoping that this head fake fails, because if this head fake fails, it's showing a good shift in supply and demand. More supply is coming into the marketplace, which is good. So you don't want to touch it. You want to leave your trade alone. Now this is what we do with the managed trade solution. We're looking at trend and we're looking for these key reversals. We're looking for price exhaustion points, that we have at proprietary levels, at macro numbers, trend reactionary numbers, and also my wave system. Really, my wave system basically tells me a good indication of when it's over and we should be starting a big move down. Does it do it all the time? Absolutely not. Okay, but it gives me a good indication of what I should be doing. And if it's not working, you know what I do? I step aside and I wait and I keep my powder dry. And then, lo and behold, an idea comes and another setup comes and it works. So sometimes it's just as important to be not in the market as it is to be in the market. Okay, so, and there's the move. Okay, now it starts going. Now I want to show you something here. How important pivot points are. We have a pivot low here that we broke. Okay, for me that means that we're probably going to go down to here. And I'm just looking for pivot lows. Okay, I'm not looking for anything really special. sitting flat for days, you know. Wow. What a... See, I wouldn't want to trade this thing. And there it is. I mean, we come very close. There it is. And there we touch it. Let's see what happens. Spike up from it. Whoop. And there it is. Okay, and here we are today. Okay, 145.49. All right, so in this hunting for head fake, you learned what the head fake was if you didn't know. You also learned what a key reversal was. You learned where you should be looking for head fakes. You learned about the market paradox. Okay. Now I just want to add one other thing for you guys, which you can do, and I want to add to you really briefly because I know this webinar has been taking a long time, and I'm going to be covering this in the webinars for our trading group. So hopefully you'll become a member. But I want to talk to you about the Vinci trading system. Okay, the Vinci trading system basically you can use on 4 hours. You can use it on the dailies. Okay, and what you're doing is you're plotting 20 bar highs and 20 bar lows. It's really simple to do. Okay, and you're looking for head fakes at whatever the current 20 bar low is or the 20 bar high is. And what you're looking to do is you're looking to buy as close as you can to that 20 bar low on a head fake, and you're looking to sell as close as you can to a 20 bar high. So if the marketplace has generally been channeling, okay, and you're counting your bars, all right, let's get rid of all this stuff so I don't confuse ourselves here. Okay. If we came into the marketplace, well, this would be a 20 bar low. Okay, so it's lower than all previous 20 bars before it. So we'd be looking for, you know, head fakes right on the head fake bar itself. That would give us a good indication, okay, buy it, right? Put your stop below it. As the market progresses, okay, you're basically going to be looking at pivot points to escape, okay? But the idea, and it's a very simple idea, I call it Da Vinci because I developed it in Tuscany with a group of Italian traders, and we were using a very famous trader's trading system, and we reversed it, okay, because we knew that his system basically failed 70% of the time, but in the 30% of the time that it made money, it made phenomenal money. And that trader's name was Richard Dennis. So we just basically started messing around with it, and the head fake was developed at the time. So we were looking for head fakes at 20 bar lows and looking for head fakes at 20 bar highs. Now, we were also always looking at what the overall trend was too. You know, what's the marketplace been doing? You know, so if it's in the middle of a range, you know, even if a 20 bar low is created, let's say it's in the middle of a range of a daily range, and if you're trading 1 hour, for instance, you know, maybe you want to just leave it alone. But very simple. Look for a 20 bar high, 20 bar low. Look for head fakes around that point. Sell against the 20 bar high. Buy against the 20 bar low. I really enjoyed giving you guys this lesson. I hope that it was an eye-opener for you with the market paradox. I know that nobody really talks about the market paradox, and I look forward to seeing and hanging out with you guys real soon. Cheers.